There are things you can't do like other
Good morning, everyone. This is Financial Literacy 101. And today, I know a lot of people have been asking me about option trading. There's a lot of money, a lot of money to be made in option trading. But there's a lot of people on YouTube and other platforms trying to explain option trading. There's some classes you can take for option trading. This is going to be a quick, low down, dirty version of option trading. I'm going to try to make it in its lowest form for anybody who's trying to get into maybe some low call options or some low put options. Then you'll be able to make some money. Okay, so I'm not going to try to speak over your head. I'm going to speak directly to you. So first and foremost, the book answer of option trading is: options are contracts that give you the right, but not the obligation. It gives you the right, but not the obligation to either buy or sell an amount of some underlying assets. We're talking about stocks in some instances here, at a predetermined price at or before the contract expires. You guys always hear me talk about option trading and about the risk in buying an option close to its expiration date, because you'll hear the term that it expired out of the money, meaning you didn't make any money, okay, or it expired in the money, okay, meaning that there was some money to be made there. Nonetheless, so options can be purchased like most other assets, okay, with some sort of brokerage account: Robinhood, WeBull, M1 Finance, Fidelity, TD Ameritrade, E-Trade, so on and so forth. Because we need to understand that options are very, very powerful because they can enhance your individual stock portfolio. Okay, they add some sort of income and protection and leverage, and they're also a sense of hedging. And we're getting to that. Hedging is a kind of like insurance for your stock. Now, it depends on the situation. There's usually an option scenario appropriate for an investor's goal, okay? So some people may just do it to hedge their other stocks. And I'll quickly show you, I'm going to show you later on how we're going to get into this, but I'll quickly show you this very quickly, the options I have going on, and try to speak to them, okay? So right now you're looking at my options. Let me blow this up for you. Robinhood doesn't do a good view, but here are my options right here. So I have 1, 2, 3, 4, 5, 6 options, and they put them in the order in Robinhood of the way they expire. So my NEO option, I called it at $54. So we can understand, if I come down here to NEO is at $46. Now, there's an applied risk hit and the implied volatility, but this is very, very risky. I bought this option within the month of December. That's not a good practice of buying options. You really want to buy only long-term options. What am I talking about? If you were to buy an option right now, take for instance, I have an option that expires in April. If you're a beginning option trader, I would advise you to buy options anywhere from 4 to 6 months out, okay? Now, my next option, you see that I'm $820 plus. Let me see if I can blow this up one more time. There we go, $820 plus. Now, this is my second blink call option, but again, this is risky because it depends on the performance of that stock. Now, I was expecting Robinhood, because of the trajectory and the potential for growth and a lot of money indicators, that Robinhood was going to hit 54 by now. But it didn't. It had a market correction, it had a stock correction, it had a lot of pullbacks, and it's still pulling back. So I'm in bed for $726 that I could possibly lose here in less than 10 days. But I digress. Now, Blink charging is doing absolutely phenomenal because I'm already plus $890 on that option. Okay, Klein, I'm not really worried about this one. I have until January 15th. But the first sign of growth, because it's so close to its expiration date, I may sell this one. I also have Lit, same thing with Lit. Art Fine Tech is another option that I have, but it expires in February. So I'm looking at beginning January to get rid of this option because most likely, believe it or not, most option traders get rid of their options anywhere from 60 to 90 days before the expiration date if you're doing safe option investing, because during that time frame you have a lot of volatility. And I'll show you some quick tricks how to make some real quick money doing option trading right after this, because I got to give you the background. I got to give you the basic information that you guys need in order to understand option trading, because somebody can teach you how to invest, but you also want to understand why you're doing what you're doing. Now, a lot of these prices are predicated upon what they call as option derivatives. Okay, options belong to a larger group of securities, stocks, known as derivatives. A derivative price is dependent upon or derived from the price of something else, stocks. Options are derivatives of financial securities, stocks. Their value depends on the price of some other asset. So options are option for a particular stock derived on that stock's price. So again, I showed you here about NEO, just giving you some contrast here. I showed you about NEO, that NEO is at $46. I called this, meaning that I projected that NEO was going to go up to $54, okay? At $54, but no, it has not. It's actually retracted. So if I did a call option, I would have made some money. But since I did a call, let me make sure I say this correctly. Because I did a call versus a put option, that's why I'm losing this much money, because a put option is saying, well, the stock is at $50. I'm expecting the stock to drop down to $46, $47. So if you put in put options, you are banking on the fact that the stock is going to decline in price, versus a call option. You are banking on the price going up. So that's a big difference. Calls, you're saying that the stock is going to go up in price at the price point that you predetermine. Puts, you are banking on that the stock is going down at the predetermined stock price that you actually put. And if you notice, my Blink charging option is already at plus $1,000. So I'm making money right here. So I've done 2 Blink options in the past week, and I've already recouped the money that I lost with my NEO option if this NEO option expires out of the money. And we're going to get into how option trading is very, very powerful for you can have added income. I kind of use option trading to reinvest. I use option trading to reinvest into other stocks if I need it. But look at my price over here. I'm at $26,000. I'm up $989. Why is that? Because of my option trading. This is part of my total portfolio. Okay. So let's go back. Because I really want you guys to key in on the information versus the money, because we can kind of get lost there. Because we need to understand that these derivatives, their value depends on the price of the stocks. Quite simple, okay? So again, I want to make this very, very simple. If you do a call option and you set your call option like I did with NEO at $54, you're saying NEO by this date, by December 31st, is going to hit $54. And if it hits $54, you make a profit. If it goes above $54, you make even a greater profit. Now, the same works in reverse for a put option. You say, well, NEO is $50 right now. I'm going to put an expiration date at 12/31. I'm expecting NEO to hit $45 or $46. Once NEO declines to that particular price because of your put option, you make a profit, because, again, you are banking on a predetermined price of it either going up with a call or down with a put. Now, let me give you the basics. Call and put options. Options are a type of derivative security, as we went over just now. An option is a derivative because its price is intrinsically linked to the price of something else, meaning that stock. If you buy an option contract, which this confuses a lot of people, because what happens is when you see within one option, there is 100 shares of that stock, but not totally, because it's not the total stock price, if that makes any sense, okay? It grants you the right, but not the obligation to buy or sell an underlying asset, meaning that stock at that particular price. So let me go back. I want to do a lot of compare and contrast so I don't lose anybody with just a bunch of jibber jabber, right? Which you see a lot. So if I go in here with my blink call option, okay? So I bought this I bought this option, which is 100 shares each. If you can read over here, contracts 100 shares each. So if you buy one, it's 100 shares, okay? But you're not paying that price at the current price of Blink charging. The current price of Blink charging is $51. You're not buying it at that because you're buying an option to buy at a particular price. So my call was $43. Look at this, ladies and gentlemen. Blink charging is skyrocketing. So I'm making really, really good money. So when I come down here and I'm looking at, I got two contracts. I break even at $40.60. I'm well above that. But my average cost per share is $5.60. So I am buying 100 shares of this option at $5.60. I just want to pause right there so you can understand that I am not buying this option at $50 per share. I'm buying 100 shares of this option at $5.60. But let me tell you, ladies and gentlemen, I never have, not saying that it's not a good choice or it is a good choice, I have never, ever executed an option. I've always made money of the option going up before the expiration date or going down before the expiration date. Because that's where the money really is. It's not buying all the stocks because you're trying to use that option as added income. Also hedging your other volatile individual stocks in your portfolio, okay? So a call option gives the holder, you, the right to buy stock, and a put option gives the holder the right to sell a stock, okay? Think of a call option as a down payment, but here's a good example, because I know a lot of people are familiar with houses, okay? So take, for instance, a potential homeowner sees a new development going up. You're like, oh, they about to build a new housing segment. I'm actually in the market to buy a new home. So have that in mind. So that person may want the right to purchase a home in the future. Like, once they really start building over here, I want the right to buy a house. Excuse me. But we only want to exercise that right once a certain developments around the area are built up. You're like, you know what? I want to buy a house over here, but there's no infrastructure. There are no stores, no gas station, no grocery stores, no clinics, no dental office. I want to wait, but I still want the option to buy. You get what I'm saying? So keep that in mind. So that potential home buyer will benefit from the option of buying or not. Okay. So imagine they can buy a call option from the developer to buy the home at, let's say $400,000 at any point in the next 3 years. So picture you have the right to buy Blink charging at $51 at its current price, even though it goes up. You get what I'm trying to say? So take, for instance, I had this call at $43, okay? $43. Let's go back. I don't want to lose anybody. Let's go back. At $43. So I want the right to buy this option at $43 per share of 100. So I'm only buying a fraction times 100 of 5.60. So even though that this stock is now at $51.69, I can buy 100 shares at $43 if I execute this option. Okay, because I'm banking on the predetermined set price that I did for the call option. This is very essential. This is very, very essential, okay? So let's stay with me here. Stay with me. So I'm buying a home at $400 with the option within the next 3 years to buy. So at any point in the next 3 years, I can buy this home at $400,000, even though that the neighborhood property value may triple, may double, may quadruple, okay? So but you buy in this option with a non-refundable deposit. Non-refundable deposit, naturally. So a developer wouldn't grant such an option for free. So if you was trying to, say for instance, you're in a home right now and you have the rent to buy. okay, or you're in the lease, but you have the rent to buy. So at the end of the contract that you already had, you say, I'm gonna continue to rent, boom. Or because that means you can extend your contract. Or you're like, I want to exercise the option to buy at the predetermined price of the home value when I first start renting. Because say, for instance, some people rent houses for 5, 6, 7, 8, 9, but the property value in that neighborhood actually triples and doubles, right? I keep saying it backwards, but doubles and triples, right? But you can still pay it at that $400,000 price. So this is the analogy and metaphoric way I'm trying to really drive this point across to you guys. Now, with that said, the potential home buyer needs to contribute a down payment to lock in that price. And that is where you actually investing your money inside the options, okay? So with respect to an option, this call is known as the premium. It is the price of the option contract, period, okay? So in the example that we're using right now, the deposit may be $20,000, okay? Because you put down that $20,000 because they want you to have some sort of skin in the game, just as well as option trading, okay? So the buyer pays the developer, right? Let's say 2 years have passed of this 3-year expiration of your contract, and now the developments are built and the zoning has been approved. The home buyer exercises the option and buys the home for $400,000 because that is the contract that was purchased. Now, the market value of that home may have doubled to $800,000. Case in point, compare and contrast again, ladies and gentlemen, that my option is now $1,120, but my total market value is double the amount. Does anyone see that? Look at my return today. My return today has been 100%. 100%. So for every dollar I invest into this option contract, there was a call, I doubled my money in a day. Because somebody say, man, how did you make $3,000 in a day? Well, the increase in the stock market, the Dow, the New York Stock Exchange, the S&P 500, okay, and the NASDAQ, of my individual shares of my portfolio, then also the power of option trading. Now, a lot of people use option trading to supplement their income. You may have a guy who only makes $45,000 to $50,000 a year, but because he understands the way option trading works, he's making $60,000 a year. You're like, dude, wait a minute. I thought you only made $40,000, but how you have an extra $20,000, an extra 20 grand coming in? You're like, oh, I option trade. Because take, for instance, my portfolio right here. Blink charging, I'm at a plus 1180, whereas O'Neill, I kind of did a risky option because I bought this option within the same month. Very, very risky because of the volatility in the market. You need that time because options is like I have the right to buy and exercise the option or the right to sell and take away with my profits. Option, in my opinion, is the way to essentially rob the investing industry. And this is what I'm talking about. If you have enough money, you can go in and buy a long-term option. This is what I advise. Buy a long-term options, okay? And they're going to cost you a couple of $100 to a couple of $1,000 depending on what option, either be a call or put of the asset, the stock that you actually buy. But again, I'm going to show you one quick way that is more than 80% if you do your homework, if you do your research, of you making great money. The same way I've done with Blink charging. But let me just finish up with my talking points, and I'm going to show you this option without haste. But we understand that you bought this property at doubled at $800 because the down payment was locked in at a predetermined price. Again, I called it at 43. Blink charging is at 51. That was a predetermined price. So now the only thing I'm gaining is profit on profit on profit on profit. Okay. So now in the alternative scenario, we can also say that the zoning didn't get approved. So this 1 year past the expiration date of that option. Now the home buyer must pay the market price because the contract has expired. And this is a sense of your option expiring out of the money. So let's get into this very quickly so I can show you this, ladies and gentlemen. Okay, let's just pick a stock. Let's pick a stock. Let's pick Tesla. A lot of people like Tesla, okay? A lot of people love Tesla. So you come over here in Robinhood. This is the Robinhood platform. I say trade Tesla options. Now, I have a couple of options here. You get it? A couple of options, option trading. Never mind. But anyway, so buy or sell. Okay. So I don't have any options to sell. So I'm automatically going to buy. Now, call, meaning that I believe that Tesla's going to go up at a predetermined price. Put, meaning that I'm banking on Tesla going down at a predetermined price. Okay. And you always hear on Robinhood, you see right here, here's the current price of Tesla. Okay. The current price of Tesla. So me, I lean more to the market doing well than the market doing bad. Now you have some option traders who do calls and puts. Me, I lean more heavy on calls. So let's do calls. Now, since I know that I'm a buy here, a call, then my next thing is I look at a couple of things. Okay, I look at a couple of things. All right. So the first thing that I look at, I say expiration date. Now, December 31st, the volatility in this is going to be absolutely staggering. I don't want to buy it this close to its expiration date because a lot of things could occur and I can't retract my money. I don't want to lose any money. So the first thing I do is like, okay, well, let me see the date that Tesla has for their option trading. Do you know that I can do an option trading a year out? I can actually, if I had enough money, I can do January 20th, right? 2023. But I'm buying 100 shares, a fraction of 100 shares at $231. This is what I tell people. Buy the option. Listen to this. Buy the option at the current price. Don't go above or below. This is my strategy. So what is he talking about? So right now Tesla is at 656. So instead of going up to 670, like, oh, Tesla's gonna hit 670 by January 2023. That's not where the money is. The big money is buying it below the current option. Below the current stock price. So right now, you see right here on this line, ladies and gentlemen, let me blow this up. Right now, the current stock price of Tesla is 655. But I'm gonna buy this option at 650. But it's gonna be very, very, very expensive. But I'm already in the money. You see what I'm saying? But it's going to cost you some money to get into this price. Let me see if I can decrease this so you guys can see the total screen. All right. So I'm buying. Here it is, 650 call. It expires January the 20th, 2023. We're talking about 2 years out. Total cost is $231 times 100. Remember that. Okay. So here I am. I'll put one option in. I'm not buying this, of course. $23,185. But ladies and gentlemen, let me tell you, soon as you buy this option, you're going to make money because you're buying it below the current price of the stock is 656. You're buying it at 650. This is what I did with blink charging. This is how I started making money very, very quickly. So let's do something more reasonable. Okay, let's go back. Let's do a stock more reasonable, but that I believe is going to do very, very well. So let's do something like Phantom Holdings. Let's see if Phantom Holdings have any options available, okay? So Phantom Holdings don't have any options. Okay, I'm not going to get into why some stocks have options, some stocks don't. What else can we do? Let's see if Upwork. Let's see if Upwork have any options. Let's look at Upwork. So Upwork does have options. Let's go into Upwork. We're looking for buy. We're looking to call. And then right here, they said that this option is expiring at January 15th, 2021. So we're already below a month. The volatility in this is very, very dangerous. So I want to look at the other options they have. So January, I at least want to go at least 4 to 6 months out. So I'm going to go 6 months out. Then again, this is going to be very, very expensive because again, my strategy is buy it below the current share price in order to make instant profit. In order to make instant profit, you must buy the call option below the current stock price. Now, this is what I also look at. This right here, what is called implied volatility, is a good indicator of the chance of the percentage of it going up or it going down. But because I'm buying it below the current stock price, my chances of it going up in the next 6 months is greatly increased. So with that being said, I said, I want to buy this call option at $8.75. That's how much this option costs, okay? At a current price of $46.25, okay? Because this is a 37.5, so $37.50. I hit continue. Now, contract 100 shares each, okay? And again, I'm buying this between $8.60 because of fluctuating the market at a limited price of $8.90. So I'm gonna put in one. So we already know there's gonna be what? $860, okay? So $880, okay? But you get my drift what I'm getting at. These options are gonna be very expensive because first and foremost, you are hedging your stock portfolio because the market can go down, but as long as this stock stays above the $38 that you predetermined, okay, you're gonna make good money. Or you're going to at least break even. Here's my thing. At the end of the day, if you're break even, that's not bad. You left no money off the table or any money on the table. Now, some of you may be asking, so when I make this profit, this like I'm making profit off of blink charging right here at $1,000. You're asking yourself, when do I exercise? When do I sell that option? I can sell this option right now and make this $1,000. But this particular stock is blowing up, okay? So am I being risky because the expiration date of this option is less than 3 weeks? I'm being very risky. I can actually lose some of this if this stock starts to decline below the predetermined price that I bought it at. Some people, once they hit 100% here of their total return, meaning they gain a dollar for dollar investment, they would sell this particular option. And then here's the thing, ladies and gentlemen, because options come and go and they have expiration date, most people just put this money back in their bank account, okay? But see, what I do is more times than not, when I take my option trading money, what I do with it is I take a fraction and I buy another option, and then I may transfer some of that money to my bank account. Or I take the entire profit of my option and I buy stocks that I couldn't normally afford, like Tesla. Tesla is getting up there again. It's very, very expensive, okay? Because some people, they come out here and say, oh, Tesla's $657 a share. I have no money with that. But if you understood the power of option trading, then you will have enough money to buy at least a share or two, depending. But the risk in option trading is the risk. There's a lot of risk in option trading, ladies and gentlemen. And let's go over the hedging, because options were really invented for hedging purposes, and that's kind of like insurance for your stock portfolio. Because hedging with option is meant to reduce risk at a reasonable cost. It is meant to reduce risk as a reasonable cost. Because as you can tell me, I'm like, yo, if you buy your call option at below the current share price, you instantly make a profit. So you see already how it's hedging your stock portfolio, because even though your stocks in your portfolio are declining, your option is inclining because you already bought it below the current stock price, okay? So when you think of this, think of using options like an insurance policy. Just as you insure your house or your car, options can be used to insure your investment against a downturn in the market. But here's the thing, ladies and gentlemen. With any sort of investing, there comes risk. And option trading can be risk, especially when you are buying an option, whether it be a call or a put, at a very, very close expiration date. Anything within a month is risky. And most option traders will tell you anything within 60 days is risky, okay? But definitely, a lot of these option traders actually buy call and put options within the month. When they hear information about a company that's filing bankruptcy, they're going to put in a put option regardless within a month, and they're going to make that money. If the CEO or the CFO is stepping down, or like say for instance, Prius, this was speeding up by themselves, so they have a lot of car issues, they're going to put in put options, okay? Or if a stock does business, a large contract with another large business, they'll put in a call option. within the same month because of the pertinent information. The indicators in the market tells them that this stock is going to go up 1, 2, 10%. So they'll make money even on the risky option. Now, me personally, I like to go back to my portfolio. Okay. I want to show you my portfolio because I made a risky option. I was banking on that NEO was going to go up to $54 by now when it was at $50. So I bought a $54 call option and the expiration date was 12/31. I bought it within the same month. Guess what? NEO had a market correction. NEO had a market pullback date. Because it hasn't rebounded yet to $50. Okay. Do I still believe that it's going to rebound to $50, even hit $54? I absolutely believe it will, but I may lose all the money in this option. I may lose all the money in this option. Now, these options I have over here that you see in the red, I'm not really worried about these right now because this one is a really small option. I'm losing at $7 here. ARC FinTech, that doesn't expire to February, and AMD doesn't expire all the way to April. So I'm not even worried about that. Okay, I'm not worried about those options. So again, let's go back and let's look at some popular. Let's take Plug Power for instance. Let's take Plug Power. So right now, I'm looking about options with Plug Power, and I made some really good money, and I'll show you my history. So right now, I'm looking to buy a call, but the expiration date is December 31st. Again, this is very, very risky. And don't look at the price because the closer you are to the expiration date, the cheaper the option is, but the risk in that option is greatly increased. And I'm gonna give you an example here. So I want you to look at these prices over here: $1.24, $1.67, etc. Correct? So if I come over here and once I change the expiration date, watch how all these prices here increase. I'm just going to go to January 22nd. So I'm going to go about a month out. Look at the prices now. So you see how there was $1, they raised all the way to $3 because they said, hey, if you buy a call option at $36 and Plug Power is already at $36, you come in an instant profit, and then you have the time to make even more of a greater profit if Plug Power goes to $37, $38, and you bought it at $36. So you gain all the profit off of that. This is an easy way to understand option trading. I'm trying to show you guys an easy way to understand option trading, even if, because some people, I was on it, I'm doing research and say a lot of my subscribers really want to know about option trading. What's an easy way to really do option trading for people who are trying to get into space but not talk over their head? Because I know I was looking at video like, I would explain that differently, because I want people to understand it. So again, a great way to make a lot of money in the stock market is option trading, but it's going to cost you, and that's that down payment of the house analogy. And I always tell people, now there's risk in this, but there's certain strategies that more times than not, that 7 out of 10, 8 out of 10, you're going to make some money. And one of my strategies is just for me. This is for me. You can do puts all you want, but I bank on the market always going up. So I always do call options. Okay. Always do call options. And when I do a call option, I look at the current share price. So again, I look at the current share price. We're looking at this all together. The current share price of Plug Power is $36. I don't come up here because the option is cheaper. You see how this option right here is $3.83 times 100. Anytime you buy an option, think of this price here always times 100. So this option is going to be $383. Now, if I come in and I buy this option, okay, if I buy this option, you see how it decreased? Because I don't come in at an instant profit. Because I'm saying, by January 22nd, my expiration date, always keep that in mind, by January 22nd, that Plug Power is going to hit $37. Okay? So let's take, for instance, I'm going to show you exactly what I'm talking about here. Let's do it. Now I'm going to get out of here. So $36, the current price is $36. So I'm going to come in, I'm going to hit this. Boom. Continue. So this is going to be $385. So I'm going to buy one option. $385. I'm going to review the order. It says deposit funds. Of course I am. I'm going to do this 400. Let's do 400 because the volatility in the market, you want to do 400. So I'm depositing the funds. Do, 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 do. There we go. All right. So max cost. Now my option went up because the stock is going up. You see that the fluctuation. So right now I'm gonna go ahead and review the order. It's good for the day. Now, if it doesn't execute, it doesn't execute, and I'm gonna hit submit. Okay. And this should take place pretty instantly, but I've had issues with Robinhood. That's just my personal take on it. Let's look at it. So it has yet to compute. Let me refresh. Let's just see. All right. Where am I? So it hasn't populated yet. Let's look. I got buying power 15. Let's look at my history. They show my history today. And they have not. Okay. Let me go back. I'm going back to plug power. Let's see if the option actually executed. Sometimes options take a while, ladies and gentlemen. That's just the way it is. But it is placed. Okay, my option is placed. Limited buy, submitted today. Good for the day. So hopefully at $3.85 per option, that will execute. Okay, that will execute. But nonetheless, I had $15 in here. So what I've been doing, my new method, I've been doing any extra money I have once I trade, I put that money into crypto. Now, I told you this, that they're expecting crypto to go to 50, 60, then somebody said 200,000. I mean, I may be 60 by the time that happens, but I'm going to take this. And with crypto, because the market is always live, the Bitcoin market, the crypto market never ends. Always do $1 less because you're not going. I won't be able to do $15 because that's my buying power, right? So take for instance this. So $15. Watch this because the market is always fluctuating. Not enough buying power, right? So essentially, you have to go in at $1 less, for the fluctuation. Okay. So this should take place. $14. Review order. Submit buy. Okay. That's all you had to do. So now I bought more Bitcoin. And I tell people that, you put Bitcoin on a recurring amount and now have $1 of buying power available. And me, I don't like any money in my buying power unless I have a plan for it. Right now, I'm just going to dump that money into, let's say Tesla. I'm going to throw this dollar into Tesla. Now, the least amount of money that you can invest in Robinhood is $1. So let me see if they let me do it. All right. That money is gone. Okay. So now I have no more money in my portfolio. My option trade is in. Right now, this amount of money that I'm making with my current option with Blink Charging, I'm making it 98%. My expiration date is January the 8th. Now, hopefully this doesn't break to $55 because I'm gonna wait till this afternoon. I think I'm going to sell this option and reap in the benefits. That is what I'm going to do. Okay. So I know you guys been talking in the chat. Let me see what you guys been saying. We got Mr. Charles Green, Mr. Jermaine Anderson. Glad to see you guys. It says, good morning, Ross. How do you decide what is the best strike price? Oh, I think I covered that. I did, me personally, I always go below. It's going to cost me a little bit more money, but my chances of making a profit are a lot higher. So what I do is I take the current share price and I always buy the option right below it because you come in as a profit unless it goes below that amount. Okay. But most likely, more times than not, when take for instance, let's say for Plug Power, let's say Plug Power is $36.50. I buy the option at $36. Okay. So when that option is executed, I come in at a profit unless Plug Power decreased less than $36. Okay. But things for you, key takeaways for you guys to remember. Whether you're going to buy or sell a call is you banking on the stock increasing in value, in dollar amount. So let's say, for instance, plug power at $36. You like, I'm gonna do a call option for $40. Or a put, you're banking on that particular stock, let's say plug power at $36. I'm expecting to go to $33. Then your expiration date, okay? The closer your expiration date, the cheaper the option is, but the risk times 5, times 10. Do you want to be risky and have a 50-50 chance of losing money? Or do you want a 80-20 chance of winning money? Okay. So again, you want that option expiration date to be anywhere from 3 to 4, but to 6 months out. It's going to be a lot more expensive, but you're going to gain more profit than lose. Okay. So there you have it, ladies and gentlemen. This is an easy way to understand option trading. If you know anybody in the space that's trying to option trade, please share this video to them. If you're not a subscriber to the channel, please give it a thumbs up and also subscribe and hit the notification bell so every time I go live, you guys get the information. This is Financial Literacy 101. Learn money and be inspired. You guys have a great and wonderful day and happy holiday season. I'm out.